You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to the Deep Dive. We cut through the noise in tech and startups to get you those essential insights. Today we're exploring some really fascinating sources, market shifts, founder wisdom, all sorts. Our mission, just deliver the crucial bits, the stuff you need to know. Okay, let's unpack this.
Yeah, and the pace is just, it never slows down, does it? It's so important to get past the headlines and really understand the so what behind it all, the deeper meaning.
Definitely. Speaking of headlines, let's kick things off with some pretty eye-popping numbers. Microsoft just smashed through the $4 trillion valuation mark.
Wow. Only the second company ever.
Exactly.
Yeah.
Strong Q2, cloud growth pushing it up, and then there's Meta.
Big stock surge there, too.
Yeah, it seems like it's driven mostly by their, hefty AI spending and future plans. Big capex coming in 2025.
Right, and these huge valuations, they aren't just numbers on a screen. They signal something important, I think. It's the market betting big, really big, on future AI potential.
So it's less about current earnings, more about perceived future dominance.
Kind of. It shows a shift in what's driving confidence in big tech. Huge opportunities, but, well, maybe some subtle risks, too.
Okay, sticking with big shifts.
Yeah.
Let's talk Figma. That's a really fascinating story. Remember back in 2022, Adobe tried to buy them for, what, $20 billion?
Oh, yeah, I remember. And the regulators blocked it. Looked like a setback at the time, didn't it?
Totally. Everyone thought Figma had lost out. But here's where it gets really interesting. What actually happened?
Well, that regulatory step, it changed everything.
Yeah.
Instead of a setback, it was a launchpad. Figma went public, not for $20 billion, but valued at $55 billion.
55. Wow. That's nearly triple the offer.
Exactly. So Figma's backers made out incredibly well. The company itself got a $1 billion breakup fee from Adobe.
$1 billion just for the deal falling through. Nice.
Right. And maybe most importantly, customers still have competition. No Adobe monopoly in that design space. It's kind of wild how regulation, in this case, led to a much better outcome for almost everyone involved. Competition works.
That's a great point. Sometimes challenging the status quo really pays off. And speaking of challenging norms, let's shift to how founders are finding startup ideas in, well, pretty unconventional ways. Like that Harvard Business School grad becomes an EMT. For $15 an hour.
Just to really understand the problems in emergency services firsthand.
Or the founder who bought a greenhouse, not just interviewing owners, but actually running one to build software for it.
Yeah, and that's the core lesson, isn't it? You can't really find those deep unmet needs just by, discovery interviews or whiteboarding. You often have to actually become your customer, feel their pain.
Right. Live the problem.
Exactly. And, that connects to why so many pitches fail, I think. People build what they think is cool, not necessarily what the audience actually needs.
That makes a lot of sense. So if you need to be the customer to find the idea, what about getting the message out? I saw this point about PR that seemed counterintuitive. A PR agency founder saying they'd rather be on a niche podcast, like Lenny's, than get mentioned in the Wall Street Journal.
Yeah, on the surface it sounds strange, right? Wall Street Journal seems like the bigger win. But think about it. A quick mention, maybe one sentence in the WSJ. It often does very little for actually getting customers. Prestige, maybe. But spending an hour on a podcast like Lenny's, where the audience is super engaged and relevant, that can drive real business.
So it's depth over just broad reach.
Precisely. It's about making your company a sort of lens, helping people understand bigger trends through your story, not just talking about yourself, providing real value that resonates.
Interesting perspective. Okay, so we've talked about building things, getting the word out.
Yeah.
But what about the tools we're using, especially AI? Can analysis ever be truly automated and, crucially, trusted? Like if an AI spits out a chart or a financial model. Someone made the point the spreadsheet is reality. You can't just glance at an AI chart and know if it works.
Yeah.
Right? Not like checking if a physical machine functions.
That's a huge challenge. There's this inherent trust issue, especially when there's no external physical reality to check the AI's output against. The AI's analysis becomes the reality you're basing decisions on. So how do we build verifiable trust into these tools? It's a really important question.
Yeah, it really is. And speaking of big questions and potential risks, let's look at this economic trend. Big tech spending. $102.5 billion per quarter on AI data centers.
It's a staggering amount of money, more than consumer spending added to GDP last quarter, apparently.
So what are the potential echoes here? Is this just healthy investment or something else?
Well, it does have some eerie parallels to the telecom bubble back in 2000, all that fiber optic cable that nobody needed immediately.
Okay, but what's different this time?
The big difference is how it's financed. Banks are heavily involved, but indirectly through private credit funds. So you have this slightly opaque debt chain. Banks lend to these funds. The funds lend to the data center companies building for big tech's AI dreams.
Right, I see. So if the AI revenue doesn't roll in fast enough,
Exactly. If it doesn't materialize quickly enough to service that debt, you could see defaults. And because it's all tied to the same bet AI demand, they could all default around the same time.
highly correlated risk.
Very high correlation. It has some echoes of the triggers for the 2008 crisis, with interconnected debt based on a single, potentially fragile assumption. It's definitely something to watch closely.
Wow. Okay, so we've covered a lot. Tech giants hitting massive numbers, regulatory twists creating wins, founders getting their hands dirty, and now these potentially serious economic questions around AI infrastructure. What does all this mean for you listening right now?
I think the real takeaway is about critical evaluation, isn't it? In this era of, super fast tech change and these complex financial webs, how do we look at the next big thing, whether it's an AI tool's promise or a huge spending trend? How do we assess it without just buying into the hype? Or worse, missing the hidden risks? It really calls for constant curiosity, I think, and really honing that critical thinking. Look beneath the noise.
Spoken Tech for your ears.